Good evening, everybody. Welcome back to another Stock Market Sundays with the lads. How are we all doing, lads? We okay?
Yeah, all good. How are you?
Good. Yeah, I'm good, man. I'm good. So for anyone that's not familiar, we've got Will George, who's here every week, and we've got John, who's with us now, and we've got Ben. So we're going to got a lot to touch on tonight. So first things first, we're going to be looking back at the market predictions from last week. So the stream isn't doing too well. George, do you want to take over for me?
Yeah, so last week, I think we opened up green just slightly. And then throughout the week, as everyone probably felt in their portfolios, went red and then more red and then more red. And by Thursday, I think we were sort of about 2% down and looking like both myself and Stream were assured for a point. And then Friday came round and I think Jay, Will and John all dipped into their pockets, brought out all their cash, pumped the markets and bought themselves an extra point, making the market swing green on Friday. It was a big rebound. So unfortunately for myself and Stream, we ended up sort of, I think, 0.1% up or 0.15% up, like really, really tight margin by the end of it. But it did end up being a green week. So a point for Jay, John and Will. No points for me, and Stream's endeavour to get their first point carries on. But better luck next time, I hope.
Yeah, so for anyone that's new here who doesn't know what we do, we start a poll at the beginning of the stream. If you think next week the market's going to be green, then obviously tick green. If you think it's going to be red, then tick red. I have just started the poll, so everybody get on that vote and see what we're seeing. So obviously at the moment, a lot of people are going green. I think they're fed up of being bears. So yeah, that's that. We'll come back at the end of the stream and touch on our predictions for the week following. So Will, if you want to take over and touch on what you want to start on, mate. So we're going to pull Will's up now, and Will's going to touch on his bit.
Yeah, so we're just looking at gold, silver, the Dixie, and Bitcoin again this week. Quite a volatile week across all sectors, really. I mean, gold did rally on Friday, as did the market, but overall it is down 7.8% for the week. But it's still up 10.5% for the month, which just shows you kind of how crazy gold has been recently. Similar for silver. Again, rallied 10% on Friday. Like, it really was a all-market rally on Friday. But then for the week, down 33%. So it just is purely all over the place right now. The Dixie did show some strength on the really volatile days, sort of Wednesday, Thursday. It grew. It showed some strength, which is good in theory, that there's volatility in the stock market, which therefore means people are then buying the dollar. So this is actually what we want to see, up 0.51% on the week. But I think that the real story out of these four is definitely Bitcoin. Bitcoin had a real wild week, to be honest, going all the way down to, I think, 59,995 was like the lowest it went. So it did lose $60,000, but we did show a pretty strong recovery, now back up to 70. But I think Bitcoin is definitely like the one to look at for this week, because it's a risk-on asset. It can be used as like a leading indicator for the general market and market sentiment. And of course, we are now into the 4-year cycle for crypto, the 4-year cycle for Bitcoin. And there is some debate. Now it's been taken over by like the banks a little bit. Now there's these massive massive ETFs with Bitcoin in. Will we still follow the 4-year cycle? But it possibly looks like we will, certainly based on the last couple of months. So I think Bitcoin is definitely one to watch, and we'll sort of see how it looks moving forward. But to go into the main topic for the week, obviously we've had a crazy week. So I think we wanted to just have a look and really delve deep into like the volatility of the week, how everything performed, what our thoughts are. So I'm just showing the QQQs here, which tracks the Nasdaq 100. As you can see, quite a big dip this week, but then that really strong, ferocious recovery on the last trading day. Same with the SPY. You can see quite a sizable dip, but now such a crazy Friday that we're only 1.01% off all-time highs. So a real volatile week. Wednesday was not pretty. Thursday was terrible. But I mean, a truly remarkable kind of a return on Friday brought us back to so close to all-time highs.
Yeah. So is there anything else you want to touch on it, Will, or is that everything?
Well, I guess I'm just showing the chart to then lead on to like the general topic of, you know, how are we feeling? Like, do we have any new thoughts this week? Are we changing our strategy? What are we thinking will happen this year? So I think just it was such like a stomach churner this week. Such volatility, such changes in the market. I think some software names are 30% down for the week. High beta was all over the place. So I think I just want to take some time to cover basically where our head's at.
Yeah, so I think the first bit to touch on to this, which is most important, what people are listening to, is how do we cope in this situation? So, for instance, Ben, you're a bit younger, and then obviously we're a little bit older, so there's a bit of a mixed age range here. Ben, how do you cope in a situation like this? You've been doing it a few years now. Like, how do you cope?
I just see it as like they're little blips in the road, really, and like, because I've got time on my side, and I always say to people, with the money that I've got in my stock portfolio is money that I don't need to deploy into anything else. Like, let's say, for instance, a lot of people that I hear have a lot of their money, especially the younger people, which is fine, which is fair enough, but have their house deposit in the stock market because they feel like they're not going to get a house in the next few years, so they're just saving up through that way, which is fine. But just know that if you are committing to that you are going to get downturns and things can happen. But the money that I put in my stock portfolio, I look at it as more of like a retirement or like an early retirement kind of fund where I'm not going to be touching it for a while. So these are just little blips in the road, and the research that we all put into our individual stocks, which is so important, you build conviction and you know what's happening with them. So I just look at it as discounts, to be fair, and it is just what it is.
And yourself, Will, me and you are the older heads here in this stream. Will, how do you cope with something like this?
That's a good question. I think it's something which I have said before, and it's definitely something I've learned over the last 12 months, kind of being involved with this, is that you need to do research. You can't have borrowed conviction. You need to know what you're invested in, why you're invested into it, and you need to truly understand a lot of things. Like, it does take time. We spend a lot of our time researching, preparing for the stream, researching, truly understanding sectors, macro, stocks, financial sheets. Like, I'm not saying this to put people off. I'm saying this to try and encourage people to actually do the work. And if you haven't got that time, it's okay to buy a global index fund and chill, because that's still a fantastic thing to do. So I would say research, build your conviction, truly build it, and not just say, yeah, I think that's a good stock. Truly have a good reason. Be able to explain your stock for 20, 30 minutes, know what the competitors are, know what the margins are, know what the free cash flow is. And these are numbers which you should really have in your head. So research, build true conviction, and I think over time you'll know what that really feels like. Those two things then equal, you can handle volatility, you can stomach the ups and downs. So that's really important, I think.
So my take on this as well is a little bit similar to yours, well, and we'll touch on the other lads. I think this is why, and this is why everyone's perspectives are always going to be a little different. At the end of December, beginning of January, I sort of positioned my portfolio in this infrastructure. I thought, obviously, the subsidies would be the reason as to why this happened. Obviously, it didn't turn out to be that way, but I positioned myself to make sure I was at least a percentage of my portfolio cash, which put me in a position to lap up these dips. And I think that's always a good forward thinking, and everybody's perspectives are different. But my perspective is, I think this is why most portfolios should be some cash. Now, I know yours is different, Will. I know some of the other lads different for saying that, but me being a percentage cash put me in a great position this week where, yes, my portfolio was down loads, but I've also managed to dollar cost average a lot of my positions, and I've also managed to open a certain amount of positions that I had price targets on my board for at the exact price targets that I wanted to get into them. Now, before I touch on with you, John, because I know your portfolio is a little different as well. George, I know you have some anchors in your portfolio. So how do you handle stuff like this?
Yeah, so for me, actually, what I do personally is not a lot at all, because the way my portfolio is structured is partly is to absorb times like this and to weather times like this, and that's through having a cash amount, like you said. And I used, I think so far, about 15 to 20% of that cash amount on these recent dips. So I've still got 80 to 85% of that cash amount there for more dips. Having ETFs and funds and global index funds as part of my portfolio means they often not a lot happens to them in times like this. Like as Will said, we're still near enough all-time highs, so actually that side of things is untouched. Effectively, they will balance out the volatility that I'll then see in the high betas or growth stocks I hold. So I personally don't really do too much because my portfolio, the way it's split out, is, as I say, it's designed to be able to cope and weather things like this. I think for those who are newer to investing, use it as an opportunity to retest your conviction in stocks. Go back through, check what it is you researched, why you like them, what you're looking, forward-looking, what it is that you are aiming for with that stock. If anything's changed, make something from there. But also more widely, if your emotions are changing, then sort of sense check yourself. You should be able to, especially if invested in individual stocks, be able to weather and get through times like this and manage your emotions. And if it's something that's affecting you in a negative way, then maybe to reflect on that and make some changes. Just use it as an opportunity to resense how you invest and your wider strategy, I'd say.
I think it's also important to actually remember that the stock market does go down. This is a feature, not a bug. And this week, the stock market, as I said, ended 1% of all-time highs. So even though we had that craziness this week, think about where your portfolio would be if we actually had a 10% dip and how you would feel then. So it's just so I think it's a good time to think and just have like a general reminder that this does happen and that's just part of it as well. So I think it's important, like a learning point as well, to understand these things, but also what really happened this week. So obviously there was a lot of volatility. The worst day was when the really bad jobs data came out, which I think was on Wednesday. Actually, Jake, can you share my screen again? Sorry. So we had some bad jobs data which came out on Wednesday, and that was a definite negative signal for the market moving forward. But Friday, the market rebounded really strongly. What changed from Wednesday to Friday? Well, I mean, I cover as much macro as I can. I don't think anything changed. So it doesn't need to be logical. It doesn't need to follow rules. It doesn't need to always make sense to you. Sometimes these things happen because they happen, or like there's certain things going on in the background, or a Wall Street seeing something which maybe we haven't seen yet, etc., etc. So
it's just one of those as well. Oh, sorry.
Yeah, sorry.
I was just going to say, like, when you said there doesn't always need to be something like a macro reason. I think like it's just healthy for the stock market, because just going up and up and up just doesn't work. Like all the valuations are just getting stretched to, well, we were all talking about obviously Palantir at one point. Like the valuation, I think at one point, like 6 or 7 months ago, went to like 600 or whatever. And there's just loads of crazy valuations. And I just think sometimes it just needs a bit of a reset. And I think that's why individual stocks got hit. Quite a lot of the low cap ones got hit quite bad. So like you say, I just think it just needs to happen sometimes. And I just feel more comfortable now that we've had a bit of a drop with, let's say, the individual stocks, like the high beta ones, because some of the valuations are starting to look a bit more attractive. So yeah.
And John, yourself as well, John, like what do you think of the volatility this week? What's your point on it?
The volatility overall, I think it was a mix of, I feel like some people are starting to rotate their funds out of tech and riskier assets and into more safer assets. In terms of my approach, I think on top of what everyone's already said, one of the fundamentals for me, it was one of the first things I learned when I started investing, is to only invest money you can afford to lose. And I think when say if, like Ben mentioned, people are investing in the house savings, if that's going down, you're emotionally tied to that. But if you know you're putting in money that you can afford to lose, when I see weeks like this, it doesn't really impact me. I had a little chat with Will in the DMs a couple of days ago, and I said I love it when stuff happens like this. I'm a little bit sadistic. I think it's an opportunity And to what Will said, if you go back to your investment thesis and you've done enough research and literally nothing's changed within your stock, there's no reason really for me to react. But to me, it goes down to number one, fundamental of don't invest what you can't afford to lose.
And I think that comes back to a little bit as a saying goes, keep it simple, stupid. And obviously that's not like an insult or anything. If you don't know that, go look it up. Sometimes just doing nothing and keeping it simple is actually the better thing to do. And obviously, I think some people, like you're saying, in this aspect can get very emotional. And if you get too emotional and you're seeing your money down, I mean, I've rotated a lot of mine around over the last few months into some more anchors, etc. But I still see massive swings. But just keep it simple, stick to the plan. Like Will said, have conviction in what you hold. Most people say they're in stocks and they're an investor, which means for a long time, it could be 5 to 10 years. So it doesn't really matter what happens today as long as the fundamentals correct.
I think it's really helped me by getting more onto the charts, and I'm intentionally using only the 4 hour, the 1 day, and the 1 week. And I think using only those 3 candles, it kind of forces you to look a bit more longer term, because you realize that it doesn't matter if you don't get the perfect bottom, because I mean, like, who does? But as long as you maybe buy at a decently low range, or you know, on that candle towards the bottom in that the general area, if you're in a good stock in 5-10 years, it doesn't really matter. So I think it is good to have this kind of thing. You know, it really sharpens you up, and it makes you want to learn more, I think, as well.
And I think I'm going to touch back a little bit. I have quite a few conversations with people in DMs when this type of stuff happens, and I always say to them, they always go, "Oh, what's happening with this? What's blah 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 blah?" And I go to them when we have these deep conversations. If you was happy buying Amazon at 216, for instance, or 230, if you're now having an opportunity to buy those type of stocks at 205 and stuff lower than that, well, it's a discount to you. So this again is where I go back to my forte on why being a bit of cash is always king, because obviously, yeah, it's not working for you in that moment, but when these opportunities arise, you ain't finding yourself doing what I was doing last year, where you're selling your funds to then buy SoFi at 8 and stuff like that. That's why I think it can be key sometimes to have a cash position, and not too heavy, because obviously you want your money working for you, but a bit of a cash position I think is great, especially with the market that we've been in the last year anyway, at least with Trump, that you never know what's going to happen tomorrow.
I think one thing to remember as well is that I saw quite a few people in the community this week, but have used their cash too early, and I've done the same before too. So I'm not saying it's like a critical mistake, but again, use it as a learning tool to be slower to deploy your cash. I think I might have said this last week or 2 weeks ago, but I think under Trump, we've kind of gotten used to these really short, sharp, drastic drawdowns and then these surging uptrends. But in reality, like, the market isn't that quick. Things can take weeks, months, years to unwind and then kind of move forward. So I think Pablo, I think Jordan, they have like more like a system where, say, if a stock drops 5%, then they might deploy some cash, 10%, 15, 20, or if it's like a high beta stock, you probably want to look at TA a little bit more, but also maybe you go more like 15%, 30%, 50%, or something like that. So just to try and look forward a bit more, and remember that the market is forward looking, to not just deploy cash so early and then left sort of be scratching your head wishing that you had cash from somewhere, because maybe you spent it too early.
Yeah, and I think, I mean, you had this little conversation. I think we'll touch on this later in the 3-day rule anyway, Will. But I mean, I did the same. I seen PayPal drop in, bought some at 48, but then I'll buy it down. But again, it's about having a plan, not rushing, not spending it all too quickly. I mean, someone's just mentioned Ondas. When stock like Ondas is a great example. We went 179 to 1080, I think it was, or 1160, back down to 450, back up to 15, back down to 750. Like, some people who obviously are part of the group, I seen selling at 14 and buying again at 13, thinking it wasn't going anywhere, and it dropped to 750. And I think you're right there, Will. Sometimes it's about being smart, a little bit patient, a little bit of attention to detail, then literally jump in as soon as you're seeing a 10% increment, because a 10% increment in a small cap isn't actually that much.
Yeah.
Is there anything else that we want to touch on that, guys? Is there anything else you want to touch on that or add to that segment there, lads?
I just want to say one thing, because what Will said, how we've had some sharp like drops and gains. Like when you look back at the early 2000s, I believe like it didn't recover for 3 or 4 years, the market. So it does sometimes take a long time. So just be prepared for sometimes years like that, where there could be a situation where it might take a few years to recover to back to all-time highs. But and then like even like I guess 2022 is one I kind of experienced. Like that was like a year of just downwards, just red. So yeah, I think obviously the last few years it's been very just the drawdowns have been crazy and then just recover quickly. But yeah, the early 2000s was pretty brutal. So
yeah, so as we can see, it took the Nasdaq 100 I think 14-15 years to actually recover its dot-com era peak. So obviously that is quite like a extreme example, but yeah, I think you make a good point that potentially things may move slightly quicker now, because at this time in the world, like we didn't have people putting in their pension money every 2 to 4 weeks into the market. So I think that does bring some stability overall, but still like things do move slowly, and it's not as fast as we've been used to it, especially under Trump. I know Trump's still here and there is a chance for a crazy weekend and then a massive rebound, but yeah, things do take time.
Do you have anything else to say on that, George or John? Anything else, or are we happy with moving on to the next segment from that?
I think my takeaway from this is that my legacy TUI position that's been minus 80% for years still has a chance to go back up to
So, Will, the next one we'll look at is the sector-wide SaaS sell-off and Claude. Obviously, Will, if you want to explain what that is for people that don't actually understand what that is first, and then go into what you want to show.
Yeah, so I intentionally didn't really mention the SaaS sell-off in the last segment, because I knew that I was going to come to it now for a few minutes. But software has taken a massive hit this week. So SaaS means software as a service. It's a huge industry. The annual revenue globally is around $400 billion. We're talking Microsoft, Salesforce, Adobe, ServiceNow, Oracle, Zoom, HubSpot, Workday, Palantir, Canva, Figma, Slack, Datadog, CrowdStrike. And these companies offer products which are really embedded into enterprise and in some of the biggest companies in the world. So a CRM is probably like the biggest and most well-known example of SaaS, customer relationship management. So it has names, email addresses, numbers, call logs with customer notes, general notes for future leads. It's a massive store of data for companies. So rather than have information scattered across Excel, Word, someone's sticky tab, someone's notes in their phone, it's all into one broad-based system on a company database. So if someone left, or if someone's ill, or if someone else takes a call from someone or an email, and like rather than that the person they're usually dealing with, all the notes are there, all the details are there. So these are really sticky products. They aren't easily moved. Like the data isn't easily transferable. And the SaaS industry has grown exponentially, a gigantic amount since the early 2000s. These are some huge businesses and really kind of core players in the overall world business, really. And SaaS companies host, maintain, and update applications on their own services. So they so we can use them on our phones, iPads, tablets, MacBooks, PCs, anywhere. So the core topic of today, after just explaining briefly what SaaS is talking about AI, but it's particularly talking about Claude. So I'm sure we all know Grok, Gemini, and ChatGPT, but Claude, made by Anthropic, is one of the becoming like the most embedded AI service for the enterprise side. So so that they have like a product like Gemini, but they also have Claude Code, and Claude Code has been widely used. It's been widely recognized as being a major risk to the current tech world, but also a massive help as well. But they've recently introduced Claude Cowork, which came out early this year. So this is a bit different to Claude Code. It's designed as a desktop agent that can read, edit, and create files with designated local folders. It performs tasks like organizing documents, creating reports, and analyzing data. It's not just someone putting in a query into a large language model, but it's for workers to automate, and actually it does actionable tasks for the user. It was built for non-technical users to utilize the capabilities of Claude Code. Claude Cowork was actually built by Claude Code. It was built in about 10 days. So to get to the crux of the issue, so on Monday this week, Anthropic released a legal tool, like a legal add-on tool to Claude Cowork. And this was seen as like another major threat to SaaS. Like it's another sector where AI is coming to eat their lunch. On Tuesday this week, $300 billion of market cap was wiped out from SaaS companies just on Tuesday. So IGV is the software sector ETF. It's a US-based ETF. You can see all the companies here: Microsoft, Salesforce, Oracle, Adobe, AppLovin, CrowdStrike, ServiceNow, etc. And this is like a major ETF. It has a large AUM. So year to date, we can see here minus 22% for SaaS, whilst the S&P 500 is up 1.27%. In the last year, down 22.5% IGV, and the S&P 500 is up just over 14%. So this is really, really taking a hit, and that's why I thought this week in particular was worth looking at it and really understanding it. We can see here that the divergence started around October the 10th, which is interesting because, of course, October the 10th was the great crypto liquidation when Trump put that tweet out about China and tariffs, and crypto lost billions and billions of dollars. And essentially, crypto and the stock market haven't quite been right since then. But SaaS essentially never really recovered after the great liquidation. And I mean, down 22.5% for a sector-wide ETF is terrible, really, isn't it? It is truly bad. Some people are arguing this is more of a DeepSeek moment, or is this time the threats actually real? And AI, as I said, and Claude in particular, is it coming for SaaS's lunch? So the sentiment for SaaS companies is on the floor. So we can see here, I think this is just, so in the last year, Salesforce down 42%, ServiceNow down 50%. The share prices are way down. The sentiment is on the floor. It's clearly going to be a major threat to SaaS AI. And I think it's particularly damaging because we thought of SaaS as some of the stickiest products with the largest moats in the world. So if AI can come for them, you also sort of think, well, what else can AI do as well? But it's not just the legacy players. Even AI SaaS startups have been severely hit as well. So this has seen like a real sector hit. It's also interesting, just on on a slight tangent, is that businesses like Microsoft, they're also looking at from a different angle. So if Microsoft loses SaaS revenue, does this mean that it'll have less money to spend on chips, on AI-related capital expenditure? So it does affect free cash flow, and it does affect their capex abilities, and SaaS is a major part of some major businesses. But I think one thing is really interesting is that these SaaS companies aren't actually feeling the pain, or they're not feeling it yet anyway. We can see that their revenue growth over the next 12 months is actually steady to growing. It's around 13.5%. Whereas the main thing that's happened is that the multiples have been severely compressed. People no longer want to pay so far ahead. So a free cash flow has taken a major hit. The enterprise value to sales ratio, we can see here 4.26, the lowest on this chart, which goes back to 2018. So, so in actual fact, the companies aren't doing too badly yet. Like, they haven't really been affected by this. I think that's because they're so sticky, because of their large moats, and they are still growing. But the multiples Wall Street, retail investors, institutions want to pay has severely come down. And I think the market's trying to price in the uncertainty of future free cash flow, of potentially future growth, because we don't know what AI is going to do. We can't reward these companies with the multiples they've always had because it doesn't look like it's going to be there anymore. And if this is the worst AI is ever going to be, as I said, how good is Claude going to be in 12 months' time, in 5 years' time? So they are generating the numbers which we want to see, but the multiple isn't being given to them. So to get into the meat and bones of it, is AI actually going to kill SaaS? So I've got 4 reasons for and 4 reasons against. So one reason why AI is not going to kill SaaS is the data side. These SaaS companies have a gigantic amount of data, CRM, and all the types of SaaS which there is, has huge amounts of company data. So basically, like the reason before that, you can't easily move, you can't easily change companies. These are sticky businesses with really, really large moats, and the data is really important, even if the UI layer becomes less important or completely not usable at all. There's also peace of mind, I think, of using these legacy software packages. Like, they've been stress tested, they're globally used, and they are compliant with laws and regulations. Say Claude spits out something for a legal document which doesn't end up being correct or isn't valid in some way. Who's taking a responsibility for that? So that's definitely something to think about. And companies are trying to protect their moat. So they're already pivoting away from pricing per seat, like basically from so they're moving away from a per user price model to trying to capture the value created. So trying to generate a bit like tokens where they are, like they're trying to charge for like the value created and like the growth and the efficiency from that side, as opposed to, right, you've got 80 employers, sorry, I've got 80 people there, so therefore you need 80 licenses to Salesforce. And these companies aren't sitting still. There's Agentforce by Salesforce, there's Virtual Agent API by ServiceNow, and these are AI native versions of their old selves. So these are trying to move, they are trying to move the times, and they're trying to protect their moats essentially. So going on to reasons why potentially SaaS will be heavily caught by AI. As I have made the point already, AI is always improving. I think it's I know I've said it 3 times now, but I think it's a key point. If this is the worst AI is going to be, where is SaaS going to be? Where is SaaS going to be in the future? And that's why it's so difficult to price in the future growth, because I think if we just look at this, the total addressable market for the SaaS companies and the AI agent side is just going in the opposite directions. This is a great report actually by Goldman Sachs, so maybe have a look at this if you want to know more. So users no longer with the rise of agents, users no longer actually need to use the UI of the SaaS businesses. So there's almost like an extra layer on top of the SaaS businesses, which sounds like it's adding complexity, but actually it's making it simpler. Like, you can effectively talk to the SaaS product, the software, as opposed to navigating it, using it. So you can sort of talk to it through the agent, and then in the background, the agent can get things ready for you. It can process things. It can do things for you as well. A lot of SaaS businesses also have tens, if not hundreds of available options and different products and different features, but most companies only use 5, 10, 20 of these. So there's a lot of bloat, and because like a Salesforce can say, oh, well, we've got all this things you can use, they are charging a premium, whereas in reality, companies aren't using all of those features. So I think maybe margins will be compressed, and they will have to chop some features to try and stay relevant and to try and save money as well. I think a really important point, which this chart does show perfectly as well, is budgets. Budgets are finite. Budgets are finite. IT spend is being diverted as we speak away from software subscriptions and more towards AI compute. So the software companies are being starved of that money because the companies paying for it would rather spend their money on AI and compute, and more on the agentic side rather than carry on paying for the software. I think David Sachs, the crypto czar and AI czar for the White House, really describes this perfectly. So I just want to play this short clip.
That's where I think the greatest threat is to the SaaS.
Is that playing actually, or is it coming out the
Yeah.
wrong speaker? It is playing, yeah.
Yeah.
Okay.
Companies. It's not, in my view, their existence. I don't think it's existential. It's where the future value capture is going to be. So let me give you an example. All these SaaS products are rolling out like AI copilots inside their tools, and some of them work pretty well, but they're limited to playing in that sandbox. Whereas you look at something like Claude Cowork right now, it has connectors to all these different SaaS tools. It can pull in data across all these different tools, and it works seamlessly across databases and tools. And that's a pretty attractive place to be, right? Like, which one of these products is going to be your workspace? Seems to me that you're going to want your workspace to be the one that spans across and gives you AI across the most data and context, as opposed to having a bunch of separate AIs inside of your existing tools. So I think the risk for the SaaS companies, it's not that they get replaced, although that'll happen to some degree, but it's that they become an old layer of the stack that now there's a new layer that gets built on top of. It becomes more legacy infrastructure. And all the action kind of moves to a new layer of the stack, and that's where the value add happens. And if that happens, it kind of cuts into their future opportunity, right? Because a lot of these companies were banking on AI as their next, you look at their product roadmaps, right? It's all AI related. So that to me, I think is the big risk, is that the value capture for the next layer of the stack happens somewhere else.
So Alex Karp Palantir, he believes that AI will stress test which companies actually provide value. He argues that most SaaS is slop, and only companies that solve hardcore problems survive the peak AI era. Sundar from Google, he focuses on the agentic workflows. He believes that SaaS will survive by embracing the agent-to-agent protocol, which Google and Salesforce co-developed, allowing different companies' AI agents to talk to each other directly, bypassing the need for the UI side. Then finally, David Cancel from Drift, a SaaS company, he argues that features are a commodity. Since AI can now code almost anything, you can't win on software alone, on the features alone. You can only win on brand and trust. So ultimately, this is the agentic layer versus the UI. Is SaaS now just a data source? Is this the death of the vendor lock-in? Do we need to buy these expensive sticky products anymore when we can just build them ourselves? We will continue to see budget allocations for software move towards agentic agents and away from SaaS. And we need to see continued revenue growth in SaaS core businesses to prove that they are AI beneficiaries and not AI losers. So that's that's the core of what I wanted to talk about. I think it's just important to cover because I think this did contribute to part of like the wider market sell-off this week. But also, these are some of the most important businesses in the world, and perhaps some of us use them. I think they will have knock-on effects for other companies which buy from them, sell from them. So I think it's really important to cover this core business, which has been around for 15, 20 years now.
John, is there something you wanted to add on to that, mate?
Yeah, so anyone who's not aware, I work in procurement, so I buy software all year round because that is my category. And what I've seen in a shift of when you're purchasing software, especially in the last 2 years, it's now shifted from this is the solution to this is the solution and what we've got within AI. And the pricing is now shifting towards just a subscription base to subscription plus token usage or subscription plus module for AI. But what reiterates Will's point is now the question is not, right, what software is out there in the market. The first question anyone asks now when we're looking for a new solution is, what can AI do? So where I'm already seeing the shift on the boots on the ground every day of, right, what's in the market to what can we get AI to do before we even see what the market can do. And that just reiterates that people are starting to now look towards what they can actually do with their compute power, and the money might shift away from SaaS because, as we'll say, is this just now a data dump and AI is actually going to get the best usage out of it? Or is there still going to be some use of software in the future, which there always will be, but these margins might now come down significantly because they're going to have to start competing with AI in terms of the value of the drive for business?
I think ultimately we are never going to see these SaaS companies at the price of 33 cash flow again. Like, it's never going to be 30 times free cash flow. I don't think the market's ever going to give that multiple again. I think it probably will settle around 15, 16, 17. But this is a major repricing of some real core businesses.
Is there anybody else that wants to add anything to the SaaS section there?
I was going to say, I think overall, similarly, my point of view is the ones most at risk to AI are those ones that have like a per seat business model. So, for instance, they sell 100 licenses to 100 different employees, but actually now these AI agents allow 10 employees to have the same production efficiency as 100. So now you're only selling 10 licenses and not 100. So I think those are the ones that have the biggest threat from AI gaining this capability. I think ultimately it is a transitional phase. Similarly to search, when AI first started being able to answer questions for you, everything search related went down because people thought, well, actually, what's the point of search then? Because AI can just do it. And that was the initial reaction. And as time went on, as we've seen with different search engines, they've incorporated AI, used it as a tool, and search has improved, and search has now grown even further. And I think it's a similar sort of thing. And just whilst we're in that transitional phase, this is quite a new capability from an AI product. So these SaaS companies haven't had an awful lot of time yet to incorporate AI. So there's going to be a drop until we see some of the tools and some of the ways in which they use it to actually enhance their business model. I think we see that. I'm pretty sure Target and Walmart have both announced they're pausing their procurement or renewing of their current agreements and deals. Just that, and that's probably just that. They're waiting to see how tools evolve, what options there are to them in sort of 6 months' time and a year's time, because obviously this space moves quite quickly. And I think that's why we're seeing some large enterprises pause on their usual agreements. I think what we do know for sure is that it looks like it's more increased demand to compute and power. That seems quite obvious from that added capability. So that's something that we can, I think, personally feel quite confident on expecting that to happen. So then how do you manage the shift in SaaS? And it's probably focusing less on those that have an interface and provide the software, more on those that have that hardware side, more of those that are going to benefit from that increase in compute and power sort of demand. My personal view isn't that software is dying at all. I just think it's in that transitional phase. It's sort of being reimagined. So naturally there's going to be a valuation reset where it may come below its fair value looking forward, but the valuation is being reset until things evolve and investors institutionally and retail wise can better understand and gauge what their actual potential and sort of future outlook is going to look like. So that's why I think we see so much of the valuation come off, just to reset until a sort of a new premium is decided in terms of what tools and capabilities we see evolve from the market. Because as I say, I mean, we've all witnessed the AI capabilities, and the AI side moves very, very quickly.
I do think it's wrong just to say, and I know I didn't say this, but I'm just talking more general. I do think it's wrong to say, oh well, because of DeepSeek and because of like the Google search versus AI stuff, that this is like just going to be like the exact same thing again. Certainly, SaaS names will some SaaS names will rebound. Some SaaS names will do really well. Some SaaS names will totally incorporate AI and be the leaders in the space. But I think some SaaS names won't ever reach like their all-time highs, and they won't ever truly recover. So this is really a process of weeding out the ones with truly core, sticky businesses, large moats, and they can adapt to the agentic side. Maybe that they can work with Claude Cowork and other AI systems to really bring these on board. So is the sell-off unjustified? I don't think it is at the moment. Will there be a rebound? Yes. Will that ETF IGV a rebound? Yes. But I don't think every single name is going to bounce back. So as of right now, it probably is a bit overdone. But just because of DeepSeek and just because of the Google search versus AI, I don't think we can just say, well, it's definitely overblown and it's all going to come back.
Anything else anyone wants to touch on that? Feel good? No, that's sound. Rotio. So next, George, you've got a bit to touch on Google, haven't you? And a bit to touch on the Google earnings, should I say. So if I want to pop your screen up, George, and if you want to take away.
Cool. Yeah. So Google earnings, and of course, Google's a massive expanse of a company. So just focusing purely on the earnings and sort of things that happened in that quarter, not a full bear or bull case for the company as an overall. So my personal opinion on it was a really, really big earnings quarter. I feel like I say it every time. I feel like they get bigger every time, but it was a huge earnings quarter. I'm not going to run through all these numbers. They're here for you to look at, or if you're in part of the community, you'll see a larger breakdown message in the Google channel. But to pick out a few, Google Cloud was the biggest driver in terms of revenue increase, up 48% year on year. So that's accelerating beyond what we've seen in recent quarters. Even stuff like their subscription side. If you think of a big subscription company, you might think of Netflix. You know, their entire business model is being a subscription company. And Google just announced that they've reached 325 million subscriptions, which is the exact same number as Netflix announced a month ago. So something that people often overlook is on Google with their subscription side is as big as Netflix in terms of subscription numbers. Obviously, net revenue is not the same, but just to put into perspective, some of the numbers that are included in sort of like the Google umbrella, they're very, very, very large. And as I say, overall, I was really impressed with the quarter, especially numbers wise. But I'm not going to go through all of it. So just to pick out what I think were the three sort of highlights from the earnings quarter, which was around AI and Gemini, around their cloud sector, and of course CapEx, as you've probably seen announced and talked about a lot online already. So to touch on AI firstly, so they launched their Gemini 3 sort of family of AI products this past quarter. So that's normal Gemini AI, so Gemini 3 Pro. They've got Gemini Imagine, Veo, Chirp, Lyrius, all of their different sort of generative AI models for images or voice, music, and it was a pretty big success. So they quoted in their earnings call that it was their quickest uptake of any model they've released so far. And already from comparing Gemini 3 to Gemini 2.5, which is obviously their previous model, they're processing 3 times as many tokens daily as 2.5. So the demand and the usage has increased massively with this new model. They reached 750 million users on the Gemini app, which is up another 100 million from last year. So again, from last quarter, sorry. So again, the numbers are just accelerating quicker, not just raising a flat increase rate. And then also really importantly, they mentioned that they, over the course of 2025 as a whole, have managed to reduce their unit costs on Gemini by 78%. and that's effectively what it costs someone to create a token through their generative AI, which is a massive difference. I think a big part of that is the fact that Google has their own self-produced chips. They use their 7th gen Ironwood TPU a lot, which is much cheaper than NVIDIA's Blackwell chips. I think by about 50% in terms of the average power usage, so electricity-wise. And of course, if they can make it cheaper, they increase usage, they increase demand, they increase profit margin. All the good numbers that you want to see go more and more green. And that transfers into revenue. As I say, their margin increase, but their revenues increase. And they also mentioned on the earnings call that revenue from their generative AI products increased 400% year on year from Q3, which is just a crazy acceleration. And with what we're seeing now is the AI side really transfer into driving their revenue side. And then also on the AI, as you may have seen already, they've announced a big agreement with Apple. So to Apple, Gemini is going to power Apple's AI products. On the surface, and when I saw it initially as well, the sort of fee that Apple was paying Google felt quite low. It was in the billions, which I know isn't a low number, but for the size of companies that they are and the sort of the scale of the agreement, felt quite low. But actually, I think on reflection, the deal sort of pays for itself. Okay, Apple is giving Google an upfront sort of agreement payment for the whole partnership. But actually, I think the bigger picture for Google is the access. What happens now is Gemini is now put out into, I think it's like 2.5 billion iOS devices. And I think that's the bigger value for Google. It's not the however many billion Apple's paying Google to use Gemini and use Gemini to power its AI tools. It's Gemini now having that reach to even more people. Of course, it's not going to be 2.5 billion extra people. I've got an iOS phone and I have the Gemini app on it already. But it does reach out to a massive pool of people, increases the Gemini usage, increases its reach, which, as I say, I think is a bigger value than just the money from Apple themselves. Then just sort of going on to it further. So bringing search a little bit to the AI side. So the past quarter was a real big sort of reimagining and innovation of their search, which of course has been Google's main driver of revenue and where they sort of started. And Gemini 3 is now in both their AI mode and their AI overview mode. So their latest and greatest sort of AI model is now powering their search. And what that is then translating into is more search queries that are expanding and lengthening. So where we have AI mode and AI view, which is a bit more conversational, where compared to previous sort of typical searches that you'd have, you're going to have more searches. If someone asks a question, they get an AI overview answer that goes more in depth, then they usually ask a follow-up question, or they ask a sort of reconfirming question. And what it ends up being is that a search isn't just a search. A search becomes a chain of different questions and multiple searches. And of course, that's driving up the numbers, driving up the revenue. What we also sort of see with that accelerated usage of search and queries is more revenue, and especially in the retail side. The retail side is sort of the biggest driving factor at the moment behind their search revenues, which then moves into the agentic shopping space. So towards the end of last year, they were exploring a sort of common standard for agentic shopping in terms of defining what the parameters of that sector would look like, what the rules might be, and doing that in conjunction with Walmart and Target and some other big sort of commerce players. In short, what agentic shopping is, sort of the theory behind it, is that you would go onto a search browser, search for what it was that product-wise that you were looking for, and effectively an AI agent would almost be like your own personal shopping assistant, where it will look for that product for you, it'll look for exclusive discounts and price valuations for you, and they'll also buy it for you. So it's this whole new sector that's being reimagined, which by 2030 is projected to produce tens of billions of dollars in revenue, of course, if it's a success. And then through that, the search revenues expand as well. So whereas search revenues for an ad would just be the ad side, if an ad then converts into a sale through that AI agent, then there's an additional commission fee that goes to that AI agent as well. So effectively, you can create like a double layering up of search revenues, and again, just expand them even further. So that's a really interesting space to be watching going forward. What they did mention in the earnings call was that sort of last year was laying the foundations for that. So as I say, drawing up that sort of common standard, exploring what it would look like. And they mentioned 2026 is the year to start deploying that. I don't think it's going to be right around the corner. I think it'll probably be the second half of this year. But it's something to be watching for sure, because that is quite an exciting opportunity and a sector that I think could grow pretty quickly if it does work well and does sort of become like a popular uptake. Then moving on to Google Cloud. As I said, we saw some big revenue growth there, so 48% up quarter on quarter, so year over year, which is just a massive increase. I was expecting 30% maybe again, similarly from last quarter, and it's accelerated even further, and 30% already was an acceleration from the quarter before that. So their cloud growth is increasing faster and faster. But I think more importantly, so are their margins, their operating margins, so what they're actually making a profit of. And again, that goes back to the theme of where Google is really showing how AI is now converting into revenue and making money rather than just increasing numbers. And of course, that's one of the big concerns with the whole talks of an AI bubble is, does AI actually pay off? And all this CapEx that's going into AI, is there any actual reward coming from it? Or is it just a pit of AI spending, and a revenue? But Google is showing the opposite here, I think. Just to talk on their cloud, so they are still increasing their number of customers at accelerated rates similar to their revenues. They're signing more deals over $1 billion than they ever have before. I think in Q4 they signed more deals over $1 billion than the previous 3 quarters combined, and 2025 saw more deals signed than 22 to 24 combined. So the demand is increasing, as we've seen shown through their backlog, because their backlog has also increased by 100% year over year. I mentioned a little bit previously, so anyone who doesn't know, Google has a little bit of an advantage over the other typical big 3. So Amazon's AWS, Microsoft's Azure, and obviously Google Cloud, who clearly don't have as much imagination with their naming scheme as the other 2. They're the big 3 sort of players in the cloud and data center space. Over AWS and Azure are bigger than Google Cloud, but Google Cloud has had a bit of an advantage for a while now in the fact that they produce their own in-house chips. Those TPUs that I mentioned, which are now in their 7th generation, they've been producing for about 10 years. And them having this in-house hardware and also the software sides, and not to overlook that they have their own programming and coding, means that they can optimize their services much better than the other people can. Microsoft and Amazon are developing their own chips themselves. They're sort of catching up to Google in terms of bringing more of their own technical infrastructure to in-house production and relying a little bit less on external partners. Like Amazon has a big dependency on NVIDIA. Google does use some NVIDIA Blackwell chips as well, but it's a blend. And as I say, they have more of their technical infrastructure in-house, which allows them to optimize better, which ultimately means they can increase their margins more freely. If you can control the coding and the hardware of a service you're providing, then you can tweak it to the best way you want it for your service to drive your revenue growth, increase your profit margin. If you don't produce your own hardware, if you're not programming and coding your own technical infrastructure, you have a lot less freedom to make those changes, and therefore your operating margin is a little bit more fixed. I think that's what we've seen a little bit for Amazon. I don't want to talk too much on it because I know we'll come on to it later. But where their operating margin has been higher than the others for a while, but sort of flatlined, not really increased. And we're seeing the likes of Google's, who are a newer cloud provider, catching up, and their operating margins really accelerate. And then lastly, on the CapEx side, which I think was probably the big headline that most people took away from the earnings quarter. So Google forecast that from Q1 of 2026 through to the end of 2026, they'll spend between 175 and 185 billion in CapEx, and that's to scale throughout the year. So what we can assume from that is by Q4 of 2026, they'll be spending at least sort of 43 to 45 billion in CapEx, which is a massive increase still, of course. And I think some analysts from Morgan Stanley are projecting that by 2027, their yearly CapEx will be 250 billion. So continual rise in CapEx, more and more so. I think from those numbers, we're likely to expect Q1 and Q2 of this year to be at least 100% gain year over year, looking at Q1 and Q2 of last year. But I do think we're seeing that those numbers return. As I say, seeing those operating margins in their cloud increase, seeing their AI sort of investment into their search, increase search numbers and increase search revenue, we're seeing that AI capex start to reward back. Not to the same extent. I don't think it's making them 175 to 185 billion dollars a year back in extra revenue, but we are seeing it start to return and pay. So I think for me, as an investor in Google personally, it's more confidence there with their conviction in their capex side, because as I mentioned on the earnings call, a vast majority of their capex is into technical infrastructure, as we'd expect. I think 60% into servers and 40% into data center side of things. So a massive amount into AI specifically. And then just to put in perspective some of the capex numbers. So this is just comparing some of the others that have been announced so far. And as you can see, that sort of classic exponential curve of numbers increasing, not increasing, but increasing faster and faster. And just to see how Google compares with some of the others in a similar sort of space. So just to sort of recap as like the main takeaways from my side. As I say, capex, probably the biggest takeaway that investors and institutions have made from the earnings call, because they were so much higher than what was sort of forecast and expected by analysts, is focused, as I said, into the technical infrastructure. So more and more conviction and doubling down, if you like, from Google into their AI drive, their cloud drive, and their data center side of things. Search is continually evolving. As I said, Gemini being incorporated into Google search through AI mode and through AI overview, and just how it creates ads as well. So Gemini is now powering what processes the ads to display to people, what's most relevant to display, and increasing the successful conversion rate of ads. And conversion rate is ads which are engaged with, ads which someone clicks a link through, and that sort of thing. So I think AI, as we've seen throughout 2025, has improved search, has expanded search, and as I said earlier, it's made search just a bigger animal, if you like. As I say, people are searching more, people are searching for longer, people are searching more complex queries, people are having more conversational queries. In search as well, 1 in 6 searches aren't even text, they're sharing an image or speaking into the voice, and that's something that we didn't have not too long ago. So it's also adding to the numbers in that sense. As I said, throughout most of these, AI is clearly driving revenue, and Google has shown that. Of course, we'll be looking for even higher conversion of AI capex spend to revenue drive to justify the continued capex and to justify the accelerating capex. And then finally, there was a lot of talk, and Will pointed out as well a couple of tweets about how do we frame and how do we view Google? Is it shifting now from an ad business into an AI infrastructure business? So from my side, I think my honest reflection is that I haven't viewed Google as an as an ad business for a little while now. I'm not sure when it might have sort of changed in my mind, but where Google have clearly internally changed their focus, changed their capex spend, as we've seen, away from search and their ad side and their network side, and it's very clearly going very heavily onto AI infrastructure, and that's their focus, and that's what they see as their route forward and their expansion forward. I don't think I've personally, since that change, viewed them as an ad business. Yes, their ad search revenue and ad revenue is still their main driver behind their revenue, and I think it still will be for a few more years yet. But long term, I think they are going to move more and more into like their revenue side being more heavily based on their AI revenue, on their data center revenue, on their cloud revenue, on that technical infrastructure side. So will I overall call them an AI infrastructure business? I'm still not sure. I guess by definition, sort of their bulk of the revenue isn't ad business. The bulk of their spend is an AI infrastructure sort of technical business. So I guess we'll wait and see how that develops over the coming years. If I had to pick one, I'm guessing I probably would lean more to the infrastructure side, just because that's where they're moving, that's where the biggest growth is, and that's where it feels like the shift is going to. Interested to hear anyone else's thoughts. How do you view Google?
You got anything to touch on that, Will?
Yeah, well, it's a very difficult question, Jordan, but I suppose in one sense, yours and my opinion doesn't really matter. It's more about how the street perceives it. And I think it's going back to the multiples I was mentioning in the first segment and the second segment. It's at what multiple does a Google trade at if they're spending that much on CapEx every year? And is this going to be I don't know, like, so from now, is it a 2 to 4 year build out, or do they need to spend hundreds of billions of dollars every single year on CapEx moving forward? Because that completely changes the business model, and that will affect their free cash flow massively, and that does affect the multiple which they're going to be given. So I think it really depends on, is this a cyclical, huge build out, and then into more of like a holding phase, and at what level of capex is that maintaining holding phase? Because I think that does affect the multiple which they're going to give it, rightly or wrongly, because I think ultimately this still is a tech business, so I'm not calling for a lower multiple, but yeah, I think it is down to those analysts do hold power, and they do perceive they help the way others perceive the business, don't they?
Yeah, I think my reflection of that is it's somewhat cyclical, where I think the accelerated spend is trying to effectively catch up to the accelerated demand and the on-surge of demand. And I think there will become a point where capacity has caught up most of the way, and sort of supply and demand evens out a little bit, especially on the data center sort of compute and power side of things. And then capex will slow down, at least on the technical infrastructure. Whether by that point there will be sort of new, almost subsectors of the AI space, I guess we'll have to wait and see, and if they'll require their own increased capex, and as they sort of go from the innovation and ideation stage into deployment and execution. But I do think, personally, from my own viewpoint, as things stand, it's somewhat cyclical, and it will either plateau or reduce down eventually. But I don't think it's this year. I don't think it's next year, and it may also not be 2028.
Yeah, and I think that's why I'm a little bit, I guess, like a little bit frustrated that the Apple Gemini deal is so low, because if you think about it, Apple aren't spending crazy amounts of money on capex. They're effectively using Alphabet's AI software, and as they are competitors ultimately as well, I almost wish that deal was 2, 3, 4 times the amount it was, because Apple's going to keep moving ahead and effectively utilizing everyone else's capex and Gemini rather than building out themselves. So that was like the one deal where we could sort of charge them back for doing that, and we didn't really take advantage. Obviously, that there are many reasons why, and I think it was important to make sure that Alphabet got that deal over a ChatGPT, for example. But that to me was like where we could sort of charge Apple for under investing for 2, 3, 4 years. But hey,
what was you going to say then? Sorry, Ben, I know you had something to add to that.
No, I just find it interesting because obviously, like you just said, Will, about Apple, they're like the only ones who are not spending the capex because, well, they've just gone ahead with just using the other big companies to spend the money on it. And it's like Google's kind of in some ways forced to spend this money, the capex that they're spending, because let's say they didn't do any of it and they didn't have Gemini, they didn't have all that, then people would have transitioned from the Google search, in my opinion, to like ChatGPT over time if they never did this whole restructure of obviously spending money with Gemini. So yeah, it's just like, it's one of those where it's like, I feel like now it's like every year they're like, we do need to raise the capex because we want to win the race of like almost being the Google of the AI search kind of thing, because like obviously Google just took away Yahoo with the searching and Bing and all that. Like no one uses those really, it's just Google. Whereas I feel like, I don't know what your guys' thoughts about this is, like, are people going to have like a go-to place to with their AI searches, i.e. Gemini or ChatGPT, or do you think it'll be spread around more, or do you think it'll be a situation like years ago where Yahoo was the biggest one and then Google just took over and had the biggest market share with the search?
Yeah, well, I think the companies are having the mindset that there's going to be one winner, so that's why they're going all in. That's why Meta's going all in, because they think that it's going to be like a winner takes all. But in reality, ChatGPT's numbers are coming down, Gemini's are coming up. So there could be more winners. But yeah, you're right. Like, it's going to be very interesting, and we'll have to see where it goes. But talking of artificial intelligence, Palantir, one of the key companies in this space, they had earnings this week.
Yeah. So what I'll do is I'll go over some numbers. We can have a look at
You
the
want to
numbers.
share your screen with me again, Ben, and I'll load it up. It doesn't look like it's here.
Yeah, so the first screen I'll show you is obviously just to show you their report. So obviously they did beat their EPS by 9%. They reported 25 cents. They were expected 23 cents. Revenue 1.34 billion was expected. They reported just over 1.4 billion, beat by 5%. And then if we have a look at the slide over
You just got rid of your
here.
screen.
I'll do that. So yeah, so the rule of 40, obviously Palantir do smash this out of the park, especially as you can see on screen. All the software companies down at the bottom there, then you got Palantir in the league of their own, and they reported 127%, which is obviously adjusted operating margin and revenue growth put together. So they get the rule of 127, which is insane. And then there's a few highlights that I'll just read out with their growth, and their US revenue grew 93% year on year and 22% quarter over quarter to 1.08 billion. US commercial revenue grew 137% year on year and 28% quarter over quarter to 507 million. US government revenue grew 66% year on year and 17% quarter over quarter to 570 million. Revenue grew 70% year on year and 19% quarter over quarter to 1.41 billion. 72% year on year and 19% quarter over quarter, excluding strategic commercial contracts. Like we said, rule of 40 score was 127%, and that's been increasing every single quarter, which is interesting to know in the future. How far can it go? Closed 180 deals of at least $1 million, 84 deals of at least $5 million, and 61 deals of at least $10 million. Adjusted free cash flow of $791 million, 56% margin. Adjusted operating income of $798 million, 57% margin. US commercial remaining deal value grew 145% year on year and 21% quarter over quarter to 4.38 billion. Highest ever quarter of US commercial total contract value of 1.34 billion, 67% year on year. Highest ever quarter of TCV of 4.26 billion, up 138% year on year. Adjusted EPS of 25 cents and GAAP EPS of 24 cents. So yeah, and then what I'm going to speak about is the ship OS, which is very interesting because it's quite similar to obviously the situation when I was investing into Palantir. They had a client called Airbus, and they were using it for obviously efficiency. And this is quite similar, the contract that they got, and I'm sure they'll build it up even more. But pretty much, if you have a look at here, so ship OS saving money and being time efficient, manufacturing time dramatically decreasing, and being able to spot problems way before time. Early detection of design of production issues prevents expensive late stage fixes, which are extremely costly in shipbuilding. Faster production cycles, faster delivery, faster revenue recognition. And as you can see, some of these stats here, submarine schedule planning.
Yeah, that's what I was about to say. It's still on that same slide.
Oh yeah, 168 hours to 10 minutes, and the material review weeks to and under an hour. And they've actually got a page where you can learn more and look at more stats, which are just actually mental, like to think this, just the reduce in time there. And obviously that's why you're seeing people getting bigger contracts, which I'll obviously go into in a minute. But so one thing I noticed as well, which I'll have to, there's so many tabs with all the things. It's really hard to keep up with everything, but I should have done what Jordan did with a slideshow. But anyway, if you have a look here, the one thing I found interesting is the operating expenses. Hang on. Yeah, total operating expenses was actually down compared to 2024 in that quarter. Obviously, overall, it's gone up, but the fact that this quarter went down, just find interesting. But regardless, the operating expenses are growing much more slowly than revenue. So the revenue is up, shows quality, and it shows the clients and that they're spending more with Palantir. Shows how good the product is. And if you have a look as well, going from that, and you scroll all the way down to their slide deck, they mention right at the bottom, so their net dollar retention was 139% in Q4 2025. So obviously current clients at the moment, customers are spending more. So they, with their original contracts that they have, they're obviously liking the product and they're spending more with Palantir. So the current customers that Palantir have, they're keeping them and they're also spending more, which is a great recipe for a great company to actually keep growing. And that's exactly what you want. And this is what's quite good with Palantir and unique. So yeah, the retention is there. So yeah, if Palantir had 0 new customers, their revenue would still grow by 39% just from existing clients spending more, which is obviously a crazy stat. So yeah, so they're just trying to find their margins. If you go off their margins, if you look back, their operating margin was 25% this time last year, and now it's 57%, their operating margin, which is obviously a huge gap up. And the other thing is as well, if you look at their customer growth, they've got under 1,000 customers, and so their customer count is 954, 34% year on year. But the other thing is as well is if you look at other software names like Snowflake and stuff, they've got 12,000 customers, I believe. But what I'm pretty much saying is and I said this years ago in my videos, is with all these testimonials that they're getting and how good this product is, and how people wanted to come back and spend more, and it's even showing till this day now in 2026, is I feel like they're still, I know this sounds a bit mad, but I feel like they're still at the beginning with it all, because there's just so many more customers that they can get. And I just feel like, if not most people in the world eventually, obviously I know there's US focus really at the moment and that's where it's growing, but a lot of companies will want to use Palantir for whatever reason they want to, because obviously it can be tailored. So yeah, and then so if you don't know as well, Palantir turns data into actionable intelligence and automation, helping companies and governments save time, cut costs, and operate more efficiently. And one thing that we've got to mention as well is, if you look at their stock-based compensation as well, It's where is it?
They were sort of well known, weren't they, for giving out large amounts of stock-based compensation, and it was a major criticism before. I think it was 11% in 2023, 6.6% in 2024. But last quarter was significant because I was at 1.8%, Ben. They brought down their
Yeah,
dilution too.
so their share dilution is down. If you look at the screen, is down to 1.8%. Their share dilution, and obviously back years ago, you can see that a lot of it was like 10% in that range. So it's obviously a lot higher, and they've reduced it quite dramatically. But even the stock-based compensation is pretty much flat, as you can see here on screen, compared to Q4 2024, sorry, to 2025. And this is as well, like when you think about it, is they don't have to really increase the stock-based compensation. Obviously, they're doing it to keep their talent with the company, but they don't really need to at the state that they're in at the moment, because the company's just performing so well and the share price has grown so much. So they don't really need to issue out as many shares as they were, because of obviously the growth that the stock price has actually had. So that's obviously working in both ways for investors, as they're not getting diluted as much as before, because like Will said, that was a massive problem, and a lot of what Wall Street was saying about obviously the dilution that was happening at the time. Yeah, so, and then one thing I want to say is just like an example quickly as well, like Fannie Mae, it was a mortgage fraud case. There's a lot of paper, reams of paper. It took our really talented investigators 60 days to detect fraud in these files. It took your technology 10 seconds. Like, holy cow, that's what they said. And it's just stats like that. And you can actually go through a lot of different testimonials, and you can see how well Palantir works and how much time it can save customers. Yeah, and then obviously their cash position is just insane now. I think it's like 7.2 billion or something like that. Yeah, I'd have to try and find it, but their cash position's building, and their free cash flow margin is, so it's 51%, which means Palantir is converting 51 cents of every dollar of revenue into real cash after capex. And then for context, good SaaS companies are 20 to 30% free cash flow margin. Elite SaaS is like Microsoft Cloud Scale, 30 to 40%, and then 51% is obviously exceptional. So, and that's another thing, is like this, the amount of free cash flow Palantir can generate in the future is going to be insane, because you're seeing all these big contracts and how big and how fast they're growing. It's going to end up being a printing machine, essentially. And then obviously Alex Karp did mention, I think it was last quarter, maybe, he said they can 10x commercial US revenue by 2030, which is crazy. Another thing that I want to show you is, I'll see if I can put it on screen. Can you see that?
Yeah.
So their forward PE is now dropped to 102, which obviously is still high, but realistically, when you think about the growth that they're having right now, that multiple is dropping quite dramatically. I mean, obviously, not so long ago here, the forward PE was 250, and then yeah, and then there's another example. Palantir was sitting at $156 with a 700 PE at the time of this post, and 6 months ago, and when it was sitting at $154 with a 240 PE today. So literally within 6 months, the PE dropped dramatically, and now obviously it's sitting at $135 and is at a 214 PE. So it's just pretty much showing you how the multiple is compressing quickly while margins continue expanding and revenue growth accelerates. So obviously their guidance they have mentioned as well. So yeah, we're for Q1 2026, we expect revenue of between 1.5 billion and adjusted income operations of between 870 to 874 million. And then they've obviously gone on to say their full year of 2026. But one thing I'll say is they're announcing revenue growth of a guide of 61% year over year. And obviously Palantir does tend to sandbag as well a bit. So I wouldn't be surprised if they hit a 70% year on year growth rate again. So we'll have to see with that. And then one thing I'll say is I just think it's with Palantir, it's such a hard company it's just hard to find a company like this that have the margins that they have and the growth rates that they're having at the size of the company that they're at now. It is going to be interesting to see where Palantir does go. And I can have a look at the expectations for Palantir very quickly. So these are what the analysts' estimates are for 2026. So they believe that the average is $1.23 and the revenue to be about 7 billion. And then in 2028, they project that it could be 14.3 billion with an average of $2.56 EPS. So yeah, that's that with Palantir. And like I say, you should go and have a look at different examples of how Palantir is used in different companies, and you'll see how amazing and how great this the customers and clients are rating Palantir. So yeah.
No, I appreciate you sharing that with us, Ben, and touching on that, and same with you as well, George. You both did great presentations on each of those stocks, so I really do appreciate it. John, I know you're going to touch a bit on Amazon now, so obviously I'm going to share the screen for you and obviously the graph. So if you want to crack on with that, mate.
Oh, can I? Sorry,
Thank you.
I apologise a lot. I've just got one thing I want to show as well. Going back to this,
share your screen, mate. Yep, share your screen. Yep, I got you.
So if you have a look at this graph as well, which is quite interesting, is the existing customer revenue 39%, and then the new customer revenue is 31%. So it just reiterates again the existing customer revenue growth. And as well, I did see this that someone tweeted, and it just goes back to the Q4 2022 and the state that the company was in, and just how dramatically the revenue changes and the amount of money that it produces. So yeah, you can pause your screen and have a look yourself, but it's just mental how quick Palantir is growing of the company. And yeah, I'm just excited for the next few quarters. But yes, I just wanted to share that as well.
No, it's all good, man. Right, yeah, John.
On Amazon. So we'll start off the stock price. After the earnings have fell up to 10%. For the week, it's down 10%. But if we look at the graphic there for the year, it is still down. So it's quite a sharp drop. One of the biggest outlines really is that they planning for 200 billion in capex expenditure, which didn't possibly land as well as they were hoping, because a lot of analysts had them down as 150 billion. So it is one third higher than what they're expecting. And this is to focus on AI, chips, robotics, and low Earth orbit satellites, which we'll get onto. So if we look at the finances for the quarter, as we can see, earnings per share was in line and revenue beat by 1%. Year over year, earnings per share is up 5% and revenue is up 14%. So not really huge. If we go into the fourth quarter a little bit further, net sales were up 14% to 213 billion. Operating income was up to 25 billion from 21 to 22 billion. And then I've got a nice little graphic here, and I just wanted to compare. And it was actually stemmed from something that Jordan said in the community around the revenue. So I took a quick look. And if you look at these 5 companies here that are spending quite a lot of money, Amazon is the highest revenue company, but has the lowest net profit margin, and by some way. And this actually came across on the earnings call. One of the analysts asked, with all the extra CapEx spending going on, and Amazon sort of not delivering as much money as people were hoping back to the shareholders, what does this mean for the future? And I just thought it was really interesting to look at that. And if you have a look, 716 billion revenue, and they're coming out of 11 billion free cash flow, and it dwarfs in comparison to the rest of the companies. Now, take this with a pinch of salt, because it is slightly different from the rest of the companies. The core part of the business is the retail side, which historically has lower margins. But I just thought it was something really interesting and key to highlight. And me and Will were discussing this. But for the full year, net sales were up 12%, and that brought in the 716 billion. The Amazon Web Services alone, that was up 20%. So there's still some high growth in the tech part of the business. Operating cash flow increased to 20%, and the free cash flow decreased 70%, down to 11 billion. And this is due to costs that they've had to pay for property and equipment, which is linked to AI alone. So not only have they had to raise their CapEx for 2026, they've also overspent in 2025. That has massively reduced their free cash flow. If we go on to the guidance for this next year, they're expecting revenue to be Q1 guidance, sorry, I expect revenue to be between 173 and 178 billion, and operating income to be 16.5 to 21 billion. What is interesting about that is this is compared to 18.4 billion in Q1 last year. So actually, this saying there is a possibility that the revenue in the first quarter of 2026 is going to be lower than last year, which also might not have filled the market with a lot of optimism going forward. But in terms of revenue growth, it's still sitting at 11 to 15%, which is the healthy figures that you sort of see from Amazon historically. Other commentary that I picked up from the earnings call was the Amazon Web Services had their fastest growing quarter, compared to the last 13 quarters. So it's starting to pick up its pace a little bit. Be interesting to see if they can continue to see that going forward. Advertising revenue grew by 22%, and this was the best over the last 6 quarters. And this has been supported by a lot of their investments into the Amazon Prime. So this is a mix of the video and the shows at the show, and actually sellers on Amazon paying for ad spaces. But talking about Prime, they had the highest ever streamed NFL game with 31 million viewers concurrently. They also debuted the NBA across 200 different countries. So they're getting into live sports. And I think, as we all know, live sports is an absolute money grab, in terms of they have to pay for a lot, but they get that back quite a lot in the ad revenue that they bring in. They've also extended their Champions League rights to 2030 to 2031. So yet again, making them a favourable streaming platform for people to have. And then the last commentary that I picked up on was around the AI chips, and that AI chips production and sales has grown rapidly. So from the Trainium and Graviton chips, their annual recurring revenue exceeds 10 billion now. So that's quite a good threshold to get over, and hopefully going forward will continue to grow and sit at a nice rate for them. And then another thing that I wanted to pick up on, which also would have contributed to the drop, is the mixed shelf offering. Now, this lets a company pre-register securities with the SEC, and then they have flexibility and control over when they can sell securities or raise debt to raise funds. And people might not like that. Amazon could offer debt, equity, or a hybrid security of debt and diluting shares to bring in more capital going forward. And this is usually done for preparing for future capital needs. It can help them time the fundraising to favourable market conditions, because they could wait until the stock is at a better price. and do it that way, and it expands their flexibility in terms of being able to raise capital. I don't think it's a bad thing. I think historically in the past, a lot of the top companies have done this and not even exercised it, but it is a overhead of they possibly think they don't going to have enough cash to do what they want to do capex wise. And obviously, shareholders don't often receive share dilutions well, especially of such a big company. So yeah, I thought that was interesting. Overall, I thought the earnings were positive. I think what shocked a lot of people was how much they're going to spend on the capex going forward. They did also mention in the earnings call, which I've just remembered, they're trying to build out the networks part of the business, a bit like AST that Jay's invested in, and they're looking to have that commercialized by the end of this year. So that's another arm of the business that will start bringing in revenue for the company. But I think for me, I think it was a positive earnings. Obviously, a lot of fear over what they're going to do going forward with capex, especially if they're reserving the right to raise more capital. But it's one of those where if you have faith in the company, you're probably not that fazed by it, but it's one to watch closely with how much capex spending there is going on. And on the right side of the screen now, you can see a comparison of all the confirmed / guided capex expenditure for 2026. And Amazon currently have the highest capex budget going into 2026. They might not spend it all, or they might spend more. But I just thought it was interesting to highlight.
Anybody else got anything to touch on that?
No.
I guess I just say that Amazon's always been quite a low margin business in terms of how they operate, and obviously the main commerce side. AWS is much higher margin, and that sort of is helping prop up their capex and support that lower margin side. And I think they've always been, their sort of business approach and strategy has always been reinvest, grow now to have more revenue in the future. But obviously the main thing that a lot of investors are taking away, and the reason for the drop, is that their capex to their free cash flow ratio is so much further off or higher than everyone else. Because as John just showed, like, their capex is the highest and their free cash flow is the lowest. And obviously those numbers don't add up. So there's going to be some sort of short-term added pressure in selling off securities or acquiring more long-term debt. But that has almost always been the way for Amazon. So I think if you're a long-term investor in Amazon, that's kind of part of the package of what you're buying into.
Anybody else got anything to touch on Amazon there, or?
No.
No. Right, Ben, if you want to show me your screen again, mate, and get that ready, we'll the next thing we're going to be touching on is the AMD and Ben's story with that. So I know you've been holding that for a while, Ben. So yeah, if you want to share away, mate, and we'll jump straight on that.
Yep.
Right, yeah. There you go, mate.
So obviously, first off, they did beat earnings. They beat their EPS of, well, they expected $1.32. They reported $1.53, beat by 16%. And then their revenue they expected was 9.67 billion. They reported 10.2 and beat by 6%. So that's AMD. I'll go through it fairly quickly because I know obviously this has been a long stream for everyone, but some key financial highlights here. Obviously the fourth quarter 2025 revenue, 10.3 billion, up 34% year over year. So strong growth with AMD. And the fourth quarter 2025 net income, 2.5 billion, up 42% year over year. And yeah, the free cash flow thing as well, at the moment, like $2.1 billion, nearly doubled year over year, which is huge. And their EPS 40% year over year. One thing I'll touch on is obviously one of my, like, the thesis for me with AMD is the fact that AMD have gone down the chiplet route compared to NVIDIA. NVIDIA have always gone down the route of monolithic, and the chiplet design could be an edge for AMD when it comes to obviously the next kind of phase of AI, possibly. Obviously, it's not guaranteed, but obviously NVIDIA are winning the race at the moment, especially as at the beginning it was obviously training And if I have a look here, data center, AI accelerator, TAM, inference growing at 80% CAGR, which is just mental. And also the fact is Lisa Su does underplay like the market a bit. Like I would say Jensen's a bit more bullish with the market with the TAM and everything. I think his predictions were higher, but Lisa Su downplays it a bit. But yeah, going back to the chiplet part of it is chiplets have a better yield cost, great for inference, and detects defects, kill one tile, not the whole GPU, which is huge because obviously as all these big companies like Meta, they'll be obviously wanting to save as much money as possible, obviously because they're spending a lot with CapEx, and chiplets could be a good answer to it. And I believe AMD will gain market share as we grow into inference. And I've got a few more charts I'll just quickly show you in a minute. But yeah, as we'll be moving from training to inference, obviously training is always going to be there in the AI space because obviously you've got to train the models all the time. But inference is obviously, if you don't know kind of the difference, like inference is, for instance, when you speak to ChatGPT and it will spit out an answer, things like that. Yeah, so AI data center training, the learning phase, AI data center inference, the working phase. Lisa Su said the company is ready to scale its AI business to tens of billions in revenue by 2027. AMD expects AI inference demand to grow 80% per year in the near term. That's what Lisa Su said. And I'll just show you as well some more graphs that I did find. And it's just what I wanted to just show is just how inference is going to be huge in the next few years, and how a lot of money will be spent on obviously they'll need the compute to do with inference AI. So you could think of it like this as well. The MI350 is the current chip that they got, and that's like the sports car engine. ROCm is the software, so that is the driver, the plus the gearbox that tells the engine exactly how to run for your specific track. The AI model together, you can get maximum performance, efficiency, and reliability, and that's what obviously like ChatGPT, etc., will like build on. So they'll build on something like PyTorch, and that's what AI companies will build on. I need to make sure I'm not rambling as well because I know we're against time. But so
do what you got to do, man. Do what you got to do.
So yeah, so just want to double check. I've got so ROCm is, so at the moment Nvidia is just winning the race with everything, especially training, because especially the monolithic chips at the time works, and they still do work, but I do feel like inference will go down the route of chiplets possibly. I know even Nvidia are starting to think about that and go down that route, but they're not calling it chiplets because they don't want to show that they're like copying AMD in that sense. ROCm is getting better and is open source and flexible, meaning it can have a future advantage as companies can be more flexible with it using different hardware. AMD or someone else comes along with better performance or price. Having an open stack like ROCm makes it easier to switch. So in the long run, that flexibility could save a lot of headaches and money if competition heats up. Whereas CUDA, which is NVIDIA's equivalent, you have to obviously use NVIDIA hardware. It's not flexible in that sense. So I'm not saying AMD is going to take over NVIDIA in market share, because NVIDIA's just got like 90% market share. But even if AMD just gets a slight bit of it, that's a lot of growth. But what happens if NVIDIA does maybe slows down and maybe AMD does catch up with what they're doing, especially with the MI450 chip that's coming out, which is what a lot of people are anticipating? Then a lot of these companies, they'll like the fact that ROCm is very flexible, whereas CUDA isn't. So they save money in that sense. But anyway, so just going on to some of the finances as well.
They always like AMD's presentations as well. They're always like their earnings presentations are always a nice colour format and how it's set out.
Oh yeah, no, that's another thing with companies. I love it when they have good presentations because it's sometimes annoying when they don't. But anyway, 390 million in sales to China from a previous backlog, plus a 360 million inventory reserve release. They had previously written this inventory off as a loss when export bans hit, but because they eventually sold it, that old loss turned into pure profit gain in Q4. Well, obviously some of this money would have come from other quarters, but they couldn't sell it at the time. So obviously it's come into this quarter. AMD has provided guidance for China sales to decrease to approximately $100 million in Q1 2026. So yeah, and then the next thing I want to touch on once I go through here. So this is massive. I thought this was actually a bit mind-blowing, actually. Free cash flow, 15.4 billion in 2025. I mean, compared to the other years, as you can see on screen, hopefully you can see that. It's just mental really to see. And I think as well, AMD could be a bit of a, I shouldn't really say money printer, that's probably the wrong word, but like Palantir, they're just producing so much cash. And I think AMD, as we're seeing with all these CapEx spends, as Jordan and John mentioned, it's just mad how much CapEx is being spent. And obviously that will get filtered into NVIDIA, AMD, Intel. Yeah, and then the next thing as well, their forward PE has now dropped to 31, which is great. I think the median is about 40. Or just under, or so it's becoming quite an attractive price, AMD. My thoughts on why AMD possibly dropped, because a lot of people were asking that. There's AMD dropped possibly because of guidance wasn't as high as people expected, even with the beat and raise, but wasn't enough. But one thing you got to remember as well, especially for the next few quarters that they give guidance on, that's not including the MI450. The MI450 comes into play in Q3 and Q4, and that's where the exciting quarters are going to be. So that's something to remember. Yeah, and I was just saying it's good that it's dropped as stocks can't keep going up. Like you can't expect stocks to always keep going up, even if they do beat earnings and they do amazing earnings, because the valuations just overstretch, and it's just good to sometimes correct and come back to reality. And that's why I'm showing you the forward PE to be 31. It becomes a bit more better to buy instead of them being up here when it was just over 60 forward PE. I'll just briefly, just to finish off, I'll just show you what analysts are saying for predictions, just so you can have a pause and you can have a look yourself. But yeah, in 2030, they believe they could be doing an average of $27 in EPS and $159 billion in revenue. So yeah, I think AMD personally could be a very good stock to get into. This is not financial advice, but I think with all the CapEx spend and the way the future is going for the next few years, I think there's just a lot of growth. And yeah.
Appreciate you touching on that as well, Ben. That was we do appreciate. Has anybody got anything else they want to add on to the end of Ben's AMD earnings there or anything?
No, mate.
No, that's fair enough. Right then, so to finish off, what we're obviously going to do, we're going to look at next week's what's going on in the market, and we'll, so if I load this up now. Where's my screen? Here we go. So first things first, we'll touch on the earnings. So some massive earnings next week. What's everybody's thoughts on the earnings that's coming up next week?
Well, hopefully Oscar's good. To be fair, I'm just focusing more on what they say, and if they're going with, for instance, 2026, this year now, we're in 2026. Are they going with the same thing of saying they're going to be profitable? I want to see the guidance more than anything, because obviously there's a bit of turbulence with Oscar with the healthcare situation. So I just want to see what the guidance give. And then I'm interested in, to be fair, I'm interested in Coinbase because of obviously what's happened with crypto. That might be, I don't know, quite ugly.
Yeah, I mean, to be fair, myself, I'm really watching the likes of obviously Nebius this week and Robin Hood. I know, Will, you'll be excited
yeah,
for Hood
Robin
as
Hood.
well. And George, you've got George, you're in Hood as well, aren't you?
I've got a tiny bit, not properly.
So me and Will with the most. Will, is what are you looking for this week, mate? What's the
Yeah, definitely
takeaway
Robin
for-
Hood. I think they're going to have a really, really top quarter, but I don't think it's going to massively move the stock. The stock the multiple has suppressed a lot recently, I think, due to crypto, due to the expected crypto winter we're going to have, less people trading, less money to be made, possibly even because we're in a midterm year, that the general stock market sentiment isn't as good, which does affect Robinhood. But strangely enough, it has been trading almost one-to-one with Bitcoin recently, and crypto only makes up about 21% of their revenue. So not quite sure why it was doing that. But yeah, a packed week, loads of earnings, but no Mag 7, so no true market movers, but plenty of names to keep an eye on, some SaaS names as well, just thinking back to what I was talking about earlier. But yeah, Robinhood, Nevius, Shopify, AppLovin, Cisco, Coinbase, all going to be interesting to me.
yourself, George? John, sorry.
Obviously, Nebius is one of my investments in there. I think they're the only one for the week looking at. I'm also interested in Upstart because I've done a stock analysis on them recently. Actually, really like the company, so I'm going to keep up to date with them. Also, what I'm going to look at is McDonald's and Coca-Cola, more just around consumer spending. What's the habits there? Also, McDonald's is one of my competitors in my professional work, so I've got to keep an update on them. Cisco, just to keep in line with some of my security players. Cisco are also in the security world, so I will have an eye on them. And then Shopify and Toast, they are also companies I've been looking at recently, and I had to write a research paper on them on Friday, so I have an eye on them as well. I think that's it for next week that I've got my interest in.
Yeah, it's quite a busy week. Like I say, you got the some of the ones like Cisco and stuff like that as well. So some pretty big companies that are reporting earnings. Has anybody else got anything else to touch on this? Will, George, John?
I guess Monday, Tuesday, Open and Spotify. Those are two stocks similar to Reddit, which seem to have had continuous earnings over the past sort of 2 years and share price rises, to see if those continue that. Vertiv on Wednesday, a really important one data center wise, so that'll be interesting to see because it seems like it's been a really big quarter for data center infrastructure. So they'll probably be quite strong. And then I'll be watching Pinterest on Thursday as well. They're such a cheap stock. They just need to talk about how they're going to grow and expand from here and actually show a sort of bit of a growth side, because otherwise their valuation at the moment is super cheap.
Do you still hold Pinterest, George?
Again, similar to like a really small amount, but not properly, just sort of following it.
No, that's fair enough. Will, anything else you want to touch on this before we look at the macro?
No, man. Let's move on.
No, Rotio. So that'll be them. So then obviously the key events next week. Obviously got the December retail sales data, the January jobs report, initial jobless claims data, January existing home sales data, January CPI, and then obviously we've got 5 Fed speakers events this week. What's everybody's thoughts on the macros going forward for next week?
Yeah, so I don't think that this week was as important until we got the numbers for the week we've just had. And because we've had some pretty dire jobs data from the week we're currently in, so I think the jobs data for next week becomes that bit more important, just to give a true reflection of where we are. I think we're finally getting data which isn't all drawn up with the last government shutdown as well. So actually, hopefully, we do get all this data because of the current partial government shutdown. So hopefully that all of this actually does come out. But yeah, I think all of it's pretty important because the macro is very slowly beginning to look a little bit rocky. Even though I do think it is important to remember that the macro can take many, many months, often many years to actually unwind. So even though we did have the rocky jobs data this week, obviously potentially next week as well, I'm not sure what the numbers will be yet, but it doesn't instantly mean that sentiment's flipped and future growth is gone, and like definitely going to be I'm in like a recession like that. Like, it doesn't mean that at all. Like, it takes like a long time to unwind the macro, and perhaps we are, but I think we are towards the start of that. So the jobless claims data, very important, and then of course the CPI inflation data on Friday is going to be really important. It's not the PCE, which is the Fed's preferred inflation data, but I think I think it's important to have a look at the CPI as well. So, and I guess with the Fed, with 5 Fed members speaking as well, it might just give like an idea of where we're currently at. Are they going to cut soon? Some people were starting to say that we should because of the jobs data this week, and possibly that they might throw their opinion out on Kevin Walsh as well, which is obviously very important to the macro moving forward a bit more towards May, June.
Anybody else got anything I want to touch on that data?
I think I always put a big focus around inflation data, so I'll be watching Friday's numbers quite closely. Inflation is a big one for me, especially with the sort of string of rate cuts that I think are obviously prioritizing job side and company side over the inflation side to see how that's evolving, because it is like a persistent issue that does need to change long term.
I think one thing that's not been added onto it as well, Will, which I don't think is a crazy, well, it's something to watch and keep an eye on, is obviously there's another possible thing of a looming government shutdown again next week, isn't there?
Yeah, we just need to see how that all plays out.
And if obviously we're looking at poly markets, for so to speak, there's a 60% chance that it happens at the moment.
Okay. Yeah, I think that's currently like a day-to-day, hour-to-hour type thing to be aware of, really, because that can change at any point.
Yep, that's exactly right. So it's definitely something to watch, but not something to linger on, in my opinion. So from that, we're going to go into predictions now. So obviously, as of last week, these were the predictions that happened. At the moment, me, John, and Will are leading the charge. The stream is having a bit of a tough drought, and Jordan obviously got one wrong as well. So first things first, let's move it down the list. Will, what's your prediction for next week?
Oh, I wasn't quite ready for you to come to me first. I think, shall I go with you know what? I'm going to go with my first bear, and I'm going with my first red week.
And yourself, Jord?
I'm also going to go bear and go red.
And yourself, Ben?
Yeah, I think it's going to be red.
And you, John?
I am the optimist this week. I think it'll be green.
Oh,
yeah. And myself, I'm currently, for most of the stream, I've been looking at the weekly candles on the SPX for the last how long, and the actual change between each week of where it's finishing at green is so minimal. It's more about where it opens. I've also been looking at Bitcoin price throughout, and it's stabilized around a 70 mark. I think green as well, so I'm going to go with green. So me and John are green. Ben, Jord, and Will are red. Now, obviously, the stream have been voting throughout. We've had 67 votes on it. We've got 66% green and 34% red. So this week, I'm going to be siding with the stream. So it's me, the stream, and John against Ben, Jord, and Will. So, yeah, it'll be interesting to see where we're at for next week. So, yeah. I believe, is there anything else that you want to touch on, lads, or anything else you want to do with any closing remarks?
No, I enjoyed the stream today. There's been so much to cover recently. I think like this year's just got off to an absolute flyer. There's been loads to cover, and then we're right into earnings. So there'll be more earnings next week, I'm sure. I'm sure we might touch on Robinhood, maybe on Nebius as well. But we're going to look at the 3-day rule next week as well. And I'm sure the market will throw up some new news and some craziness, which we will cover as our main story as well, I'm sure.
Yeah, no, and I look, Sam, I touch back with what Will's just said as well. I really appreciate everybody tuning in on these Sundays to take their time with us. Obviously, we get a fair few hundred people now rolling in and watching the streams, and obviously we've had it across the 3 channels tonight. So if you do want to follow Ben and John, their links are in the description. So yeah, John, Ben, Jord, Will, appreciate both all of your time. We're just about to hit the 2-hour mark. So, yeah, that's something else. So is there anybody else wants anything before we end the stream?
I just want to say quickly to anyone that's watching my stream, make sure to check out Jay's stream and YouTube channel, and also John, link in the description. Jordan and Will don't have any YouTube channels, but I think they should. They might do in the future, but yeah, make sure you check out Jay's channel and John's.
Rightio then, it's been great, and I appreciate everyone joining us. So thank you very much for joining us on this Sunday, and we'll see you again next week at 8 PM. Thank you very much, everybody.